In today's video I am going to talk about a topic of great interest of any forex trader, which is determining what is the best way to establish the trend of the market. This is an important part of any market analysis because it serves as a bias to filter out the low probability trading signals that go against the trend. Remember that trading against the trend is possible, but it's not advisable because it is a dangerous idea. Trying to catch trades that go against the trend is like trying to catch a falling knife. You can do it, but the chances of getting hurt are very high. Notice also that, most of the time, we tend to look for the place where the trend will reverse, and we tend to gloss over the moments where price gives us a chance to continue in the current trend. This unfortunate bias represents a huge opportunity cost. It is almost like the market catches our attention to the hypothetically imminent reversal while it silently shows an opportunity to continue in the trend. Unsurprisingly, the traders who train themselves to see this subtle sleight of hand have an obvious edge over the traders who are constantly worried about the major reversal. With that in mind, we need a good method of establishing the trend to act as a bias to our trading decisions. There are basically two elements to that. The first element is to understand how highs and lows behave in the price chart. The second element is to understand how highs and lows behave within the context of fractal analysis. First, let's understand conceptually how highs and lows behave in their simple form. In an uptrend, buyers are stronger than sellers, so the natural reflection of the market is the creation of higher highs and higher lows. The logic behind that is that buyers are strong enough to break the last high and also strong enough to stop sellers from creating a lower low. As a consequence, higher highs are created along with the higher lows in a stair-stepping motion that creates the uptrend. In a downtrend, sellers are stronger than buyers, so the natural reflection of the market is the creation of lower highs and lower lows. The logic behind that is that sellers are strong enough to break the last low, and also strong enough to stop buyers from creating a higher high. As a consequence, lower highs are created along with the lower lows in a downward motion that creates the downtrend. To sum up, in an uptrend, there are higher highs and higher lows. In a downtrend, there are lower highs and lower lows. Let's move on to the next step of the analysis and observe how highs and lows behave in a more realistic and complex way. This is done by observing two price fractals simultaneously. In other words, observing major highs and lows and minor highs and lows together. Let's carefully observe how the market develops, paying close attention to how both flows interact with each other. If you observe carefully, you will notice there are moments where both major and minor flows agree with each other. In other words, both major and minor flows are creating higher highs and higher lows. There are also moments where the larger flow marked in black is in contradiction with the minor flow marked in red. This is one of the reasons why trading against the overall trend is not a good idea, because a sell trade idea would run directly into stronger buyers. That's all well and good, but we need a way to trade in the major reversal points or in the minor continuation points. That's what every trader wants to know, and there are many different ways of answering this question. First of all, there are many things that can happen in the extremes of price because these are areas of great interest. In price extremes, we are likely to see manipulative moves employed by the market whales, fractal bars, momentum asymmetries, conflicting supply and demand zones, Fibonacci clusters, dynamic support and resistance collisions, frequency lines, and so on. The possibilities are endless, and every one of these techniques can form a strategy around them. The main point I want to tell you in this video is that you should wait at least for two market fractals to form your trend bias. You can go deeper than that and use 3 or maybe 4 fractals. If you study these things carefully, you will notice that price behaves in an orderly manner, and when the correct opportunities arise, the entire trading context agrees with perfection. Then, and only then, a trading opportunity can be taken with safety. Our current strategy for sale in the strategy store covers the fractal bar and the momentum asymmetries that can happen in major and minor price extremes. If you have interest in learning about these advanced techniques, don't forget to check it out. In this video we touched on the surface of market structure analysis and the recognition of precision points in the market. If you wish to see more videos like these in the future, don't forget to subscribe to our channel and leave your feedback below. I hope you learned something useful for your trading. Thank you very much for watching and I hope to see you in the next video.